Hello, my name is Eric Fox. I'm the chief economist here at Veros Real Estate Solutions. And with me, I'm joined by Rina Agarwal, who is senior research economist here at Veros as well. And given we're here just days after the first day of spring, we thought we would talk about the spring housing market. And we thought we would share with you there seems to be a bit of optimism this year in the spring housing market. It's typical each year that the housing market sort of falls by the wayside in the winter, gets a little bit slow. Nobody wants to move in January. And in the spring, things always start to perk up. And so this year was no exception. We were looking, however, to see if the housing market this spring was going to start to be a little bit better than we've seen in previous years. And so we started to see the signs where, yes, that in fact was starting to happen. So as an example, if we look at interest rates, they were 5.98% in February of this year. So they had finally broken that 6% barrier, which was a psychological threshold that many people were waiting to happen. And they were nearly 7% a year ago. So that's a big decrease, which would have resulted a typical buyer a $200 per month mortgage savings on a $400,000 house with 20% down payment. So we're starting to see some trickling in of buyers who were sitting on the sidelines here for the past several years. Inflation last month, for the month February, was 2.4%, and that was compared to 2.8% back in February 2025. So again, we're starting to see some softening of prices, consumers starting to feel a little bit more wealth effect. Home prices increased in 2025 nationwide by only 1.8%, whereas incomes were up 3.8%. So that gives buyers that little bit of extra buying power going into the spring. So this was shaping up to be a fairly robust and positive spring buying season. In fact, Rina, you have a hotness index that you typically put together. And what were you showing with that?
So we were seeing a sharp improvement in our housing market hotness index. For those of you who do not know, we post this housing market index on our RiskWire website, and we update it every Monday. So we saw a 7-point jump in the market hotness index from the first week of February to the second week of March. And this was quite a steep jump. So the spring housing market was looking very hopeful. It was looking like we were going to see increased activity. As you said, we were expecting more buyers in the market, and also homeowners who were locked in with their interest rates were slowly coming back up. They were putting their homes on the market. So we were really expecting to see more optimism and improved spring market in 2026. Compared to 2025 or even the previous 2 years. But before the spring market could take off, unfortunately, its uncertainty has been thrown into the market. And that is because the war in Iran has led to a 40% increase in oil prices. And because of that increase in energy prices, there is the risk of broader inflationary pressures in the economy. And that is because not only do you see higher prices at the gas pump, it also translates into higher prices for agricultural goods, for manufactured goods. And we have not seen that so far in the inflation numbers, but I think we will start to see a jump in inflation starting with the March numbers. So as a result of that inflation, treasury yields have gone up and mortgage rates have followed suit. In fact, like you said, at the end of Feb, mortgage rates had dipped below the 6% mark, and that was a meaningful benchmark for many buyers, potential buyers, in terms of not only finances, like you said, a psychological threshold as well. But now, last week, the mortgage rate was around 6.22% according to Freddie Mac, but according to Mortgage News Daily, it was above 6.5%. So perhaps that means that buyers who are already in contracts, would they withdraw from those contracts? Because not only has the mortgage rate jumped up, there is uncertainty in the market. Another thing is that, as I mentioned earlier, inflationary pressures are back up. So if people are spending more on other goods, that will bite into their mortgage payments. And then we are also seeing a softening in the labor market. The February numbers show that the US economy lost around 92,000 jobs. So, I mean, and the unemployment had ticked up to 4.4%. It's lower than what we've seen prior. Historically, it's quite a low number, but the trend is toward weakening. So again, when uncertainty creeps in with respect to jobs, with respect to inflation, buyers kind of shy away from making a huge purchase like a home. So we do not know what will be the full impact of these inflationary pressures, where we are going to land up. Do you have some closing thoughts on that?
Well, I think what we thought was going to happen is that we were starting to see, maybe into February before the war started, we were starting to get some glimmers of hope that this spring housing season was going to be significantly better than we've seen the past 2 or 3 springs. But based on a lot of Rena's comments just now, there's been a little bit more pessimism interjected into that prediction. And so whether or not it is on par with what we've seen in the past 2 or 3 spring buying seasons, or whether it gets significantly worse, remains to be seen a little bit. I mean, I will say things can turn very quickly. If there's a positive outcome, we could rebound very quickly. But I think it's going to take time at a minimum. And I think buyers for a major purchase like a home, when they see uncertainty in the market, they tend to just step to the side. So I suspect the bottom line is going to mean that our hope, our optimism for this spring buying season is probably not going to come to pass. We're going to be more in a situation where we're on par with what we've seen the past 2 or 3 spring buying seasons. And so unfortunately, we might have to wait 1 more year to see that spring buying season that we are hopeful to see.
Thank you for your insights, Eric. Thank you for joining us. See you next time.